This could be the start of the dollar doom loop like no other. Now, the dollar, the US dollar, the reserve currency of the world. A lot has been said about the dollar. I've been talking about it for years. A lot of people are calling for the end of the dollar and the reserve currency of the world. Of course, many are expecting to find out what the next reserve currency of the world will be. When will it happen? What will it be? All these types of things. But I want to talk today specifically about the dollar doom loop that we're seeing. What does that even mean, the doom loop? Well, it should be no surprise that the dollar, while most people have been kind of still living on this Ray Dalio theory of the dollar, or I should say, cash is trash, right? We don't want to hold the dollar. We don't hold cash because it's trash. It's losing value quickly. As a matter of fact, it has. It's lost, well over 90% of its purchasing power in the last decade. I'm sorry, the last century, the last 100 years. And so it's losing purchasing power. And so you don't want to hold that. You want to hold assets that are going up in value. However, we're not always in an inflationary environment. Lately, we've been in a deflationary environment, which means the dollar's actually been getting stronger. Now, I want you to keep two thoughts in your mind. The dollar has been getting crazy strong as measured in the DXY, the Dixie. The dollar's getting crazy strong when it's compared to other currencies. So the Dixie is made up of a basket of other currencies. Specifically, the euro makes up the big chunk of that. So when you look at the dollar compared to other currencies, the dollar is getting weaker. But it's possible that the dollar gets both stronger and weaker at the same time. So what do I mean by that? Well, it's getting stronger in terms of other currencies, but it's getting weaker in terms of the actual goods and services that we want to buy. Food, energy, things like that. So you have to keep in mind that we don't want money. What we want is the things that money will buy us. We don't want the money. And so we need to keep those two things in mind. Yes, it can get stronger in currencies, and yes, it can get weaker in goods and services at the same time. Let's take a look at this article, though, to look at this doom loop and see what we're stuck in and what's going to happen. So you can see here, this could be the start of a dollar doom loop, and it's really a reverse currency war. So we've been in these currency wars, and basically a currency war is where each currency tries to devalue itself. They try to create more currency for themselves, for their own country, which does a couple things. One, it puts more money in their people's hands. And two, it makes their exports cheaper so that they're more competitive in the world. And so then when one country lowers their currency, the next country wants to lower their currency, and it becomes this currency war. But this article is calling out a reverse currency war, which is something that we haven't really seen, but this is where we're at. So you can see here, the dollar's gain is the world's pain. And based on its current trajectory, the world may be in for a whole lot more discomfort. So what does that mean? So as the dollar gets stronger and stronger and stronger, it puts a lot of pressure on the rest of the world, because the rest of the world is also on the dollar standard, and they owe a lot of debt that's denominated in dollars. Now, one reason why we want inflation, or not you and I, one reason why governments, specifically the United States government, wants inflation is two reasons. One, of course, they want to print themselves more money. But two, they want the debt to become cheaper and cheaper and cheaper. A lot of people that would say that a deflationary currency could never work cite this as their example, which is it can never work because how would you pay back debt? Debt would be getting more expensive. And that's true. And that's exactly what's happening to these emerging markets. So as the dollar is getting stronger, because of these deflationary forces, as it's getting stronger, the rest of the world is having trouble paying back their dollar-denominated debts. So it's putting a lot of pain into these other countries. We can see here that the greenback is hitting multi-decade highs against currencies like the euro and yen. So yes, the dollar is getting stronger to other currencies and getting weaker at the same time. But we can see here it says a stronger U.S. currency has historically translated into a broad hit to the world economy, because for the rest of the world, who can't print dollars, of course, things become very, very expensive. And the concern is that we're in for a dollar doom loop like never before. And so a doom loop is something that's like a flywheel. Once it starts going, you're just stuck in this process of this unwind or this doom loop. And we can see it starts here with the Federal Reserve hiking interest rates at the fastest pace in decades. And so, of course, the Federal Reserve sets the price of money. And the price of money has basically been zero. Now, when they set the price of money per the inflation rate, they're technically setting the prices of everything. And so we all think, well, most of us understand that setting prices, price fixing is a very bad thing, but they don't realize that when the Fed sets the price of money, technically they're setting the price of everything. But prices of money have been basically at zero. The Fed funds rate has been at zero. Now they're, of course, aggressively hiking. We've been talking about this at length. It looks like there's another one coming up here. Well, there is another one coming up here before the end of the month. And it looks like the Fed's teetering on whether it should be 0.75 or a full point raise. I don't know if it really matters that much, which is a whole different topic. We can talk about that if you want. Leave me a comment down below. But of course, they're raising rates the fastest they've done in decades. Now, a lot of people point back to this Volcker era back in the 80s, where the Fed stopped inflation, supposedly, as the story goes, by raising rates from 10% to over 20%, 10% to 20% rates, and stopped inflation. Today, we're going from 0 to 1.5% or 2%, hardly what Volcker did. However, when you look at it in terms of the size of the move, it's actually pretty much the same. So to go from 10 to 20 is a 100% gain. To go from 1 to 2 is also a 100% gain. So in terms of the size, it's about the same. But we can see here, it says we have a European problem, which creates pressure on the euro, which sends the dollar higher, which worsens the manufacturing cycle, which then does the whole thing again. So by raising the dollar, it puts pressure on the euro. So now the euro, the European Union, I did a whole video on this on my main channel talking about how the European Union is at threat of actually breaking apart. Go check it out on my main Mark Moss channel to watch that. The EU's in trouble. But as the dollar gets stronger, the euro is in trouble. And the euro, they need to be easing. Their economy has a whole serious problem. Go watch that other video to see the whole thing. But they're being forced to also raise. Remember, reverse currency war. Typically, currency wars were raised to the bottom. Now we're being forced to raise up. And so they're being forced to raise up. But this pressure on the euro is causing liquidity. People are pulling their money out of the euro. They don't want to hold it, and they're going into the dollar, which then sends the dollar higher as more people come to it, which then worsens the manufacturing cycle, which then does the whole thing again. So as the manufacturing cycle goes down and creates this deceleration, then more people want to go back to the dollar. We can see here that CPI surging 9.1%. We saw that happen. That was in June. The Fed has much less wiggle room to reverse course. So the Fed vowed, they've committed to getting inflation back under control, getting back their target is 2%. We're at 9.1%. They're way above their target, and they're committed to getting it back down, but they don't have any wiggle room. And the reason why is because in order to get that inflation down, they have to continue to crash the economy so people spend less money. But by doing that, it causes deflation, which then means more people want to go to the dollar. This is that doom loop. I'm going to show you a diagram. I'll show you exactly what I'm talking about here. But it says here, it's a little hard to see what kind of stops this. And I guess the best answer is that it could stop itself. Sort of like when the whole system breaks. Yeah, that sounds pretty good. The question is, will the Fed sort of be able to do this implicit handoff from interest rates to global economic conditions? And this is a key piece I want to hit on for a second, which is why I've highlighted it green. So the Fed is committed. The Fed has vowed to get inflation back down to 2%. Now, they have two mandates: one, full employment; two, stable prices. So stable prices are getting inflation back down. But what if they pivot off of that? And what if they say, you know what, forget 2%, let's just settle at 5 or 6%. And instead, let's focus on the global economic conditions. Maybe they need to shore up the ECB's balance sheet. Maybe they need to shore up the BOJ, Bank of Japan's balance sheet. And they would rather focus on the global economic conditions rather than just focusing on the interest rates alone. But he says here, the author says, we're in a world now where central banks who are all dealing with the above target inflation. Everyone has way more inflation than they want, of course. They have very little tolerance for massive currency weakness, because it's thought to only amplify the pressures they're dealing with by hiking rates. So what does this mean? Currency weakness. The more they try to ease monetary conditions, the more they keep rates low, the more they try to put money into the balance sheets, the more inflation they get, which is the very problem they're trying to solve. That's the conundrum that they're stuck in. And it says, quote, we are in some sort of a reverse currency war. So instead of each country trying to lower their currency, race to the bottom, now they're stuck trying to raise that back up. Now you can see a sort of a diagram of what the dollar doom loop looks like. So we have a stronger dollar. It's been raising really quickly. As a matter of fact, you can see this right here. We're up 22% just since the bottom of beginning at the year. Now, one thing that's important to understand when you look at charts like this is not just the size of the move, but also the speed of the move. And you can see that this has happened just since the beginning of the year here. Now, we can see other similar moves, so that's a 22.5% move, which is massive. We can see back here in 2018, we had a 16.5% move, but this happened over a long period of time. This happened from January of 18 until April of 20. So we're looking at over about a 2.5-year move. Now, this one was really fast. We saw this happen in May of 2014 through March of 2015. So in about a year, we had a 27% move. So here we've had about an equal size move, but in half the time. It's pretty severe. So we can see the dollar's getting stronger, which then lowers global manufacturing. Because the dollar's so strong, it's too expensive for other nations to manufacture, which lowers the amount of manufacturing they're doing. When they do that, it lowers demand, which then lowers commodity prices, as you can see. And then when it lowers commodity prices, it lowers global trade, which then puts the whole world worrying about the economy, which is not... Of course, they should be worried about the global growth in the economy, which then causes deflation, which then causes people to want to go back to the dollar, which then causes the dollar to get stronger. And you can see the doom loop that we get stuck in as this continues. It says here, the time frame for reducing the dollar's role as the world's reserve currency was never expected to be a quick one. As a matter of fact, when you look at the last time the reserve currency of the world switched, which was the British pound sterling in the early 1900s, the dollar took over. It was about a 40-year process. So this doesn't happen overnight. It's a process that we're seeing play out in real time. And it says in the U.S., the dollar's doom loop could end up doing some of the Fed's work for it when it comes to fighting inflation. So as the dollar gets stronger, to the doom loop I showed you, manufacturing goes down, less demand on commodities, commodities go down, less manufacturing overseas, they'll go down, which is exactly what the Fed's trying to do. Lower demand, right? If you want to lower prices, you have two options. One, you can add more supply, or two, you can lower demand. Of course, the central banks cannot add more supply. They can't print food. They can't print energy. And so all they can do is lower that demand, which is exactly what the dollar doom loop is doing. But it says here, what makes this version of the doom loop so challenging is that it's a condition or an externality that the Fed, in its efforts to lower inflation and lower inflation quickly, is actually accentuating. What I think is almost, in their view, positive, because that's exactly what they're trying to do, crush the economy. Now, I don't want the economy crushed. I kind of like to have a business that pays my bills, and I bet you do as well. And of course, if nobody has any money, your business has a pretty tough time operating. So it's working for them. It's positive for the Fed. They're getting their inflation number down. Who cares about the collateral damage like you and I suppose? The question that market participants should begin to ask is, if the dollar is doing all this work, does the Fed have to go to 4.5% or something like that? And that goes back to the question that I asked at the beginning, which is, will the Fed pivot off of this 2% target? Will they end up at 4.5% or 5% and say, okay, that's good enough. Now let's go focus on the economy? My guess is I think they're going to be forced to. But I'd like to know what your opinion is. You can leave me a comment down below and let me know what you think. Of course, as always, give me a thumbs up on this video if you like it. And while you're at it, hit that subscribe button so you know when I put new videos out. And that's what I got for you today, all right? To your success. I'm out.